Okay, let me tell you about the weirdest thing in finance. And I mean genuinely weird. The kind of thing that sounds fake until you actually watch it happen with your own eyes. Picture this. It's a normal morning. The jobs report drops. Unemployment is down. Wages are up. Every headline says the exact same thing. The economy is doing great. And the market falls apart. Not a little wobble. A real, ugly sell-off. Read across every screen. Traders staring at the same good news you're reading right now and selling like it's a disaster unfolding in real time. Now here's the part that should genuinely bother you. This isn't a one-time fluke. This happens over and over, across decades, across completely different countries and completely different markets. And almost nobody watching it actually understands why. So let's figure it out together. Because once you get this, you will never read a financial headline the same way again. Here's the twist nobody tells you. The market was never reacting to the economy. It was reacting to a bet it had already made, days or even weeks earlier. Before that jobs report even existed, traders had already guessed what it would say. That guess was already baked into every single price on the board. So when the real number finally comes out, the market isn't asking, is this good news? It's asking a much colder, much sharper question. Did this match what we already assumed would happen? And here's where it gets genuinely interesting. A strong economy makes central banks nervous about inflation. Inflation makes them raise interest rates. And higher rates quietly make almost everything less attractive. Stocks, real estate, your favorite tech company's share price, all of it, all at once. So that great jobs report? It wasn't really about jobs at all. It was a hint about what the central bank might do next. And that hint scared people more than a weak economy ever would have. The market wasn't punishing prosperity. It was pricing in the consequences of prosperity. Sneaky, right? Now here's the twist within the twist. This exact same trick happens constantly with individual companies. A business reports record profits, literally the best quarter in its entire history. And the stock drops the very next morning. Everyone online is confused. They made more money than ever before. Why is it crashing? Because more money than before was never the real question. More money than expected is the question that actually moves the price. If investors were quietly hoping for even better numbers, great suddenly feels like disappointing the moment it's compared to what was silently priced in. The company didn't get worse overnight. The story people believed in simply didn't come true. This is what's called reflexivity, a feedback loop where what people expect shapes prices, prices shape behavior, and behavior reshapes what people expect next. The market isn't a mirror of the economy. It's a mirror of what everyone believed about the economy, running one step ahead of reality itself. And once you see this pattern, you genuinely cannot unsee it anywhere. A currency gets stronger on bad economic news because bad news makes an interest rate cut less likely. A commodity crashes on record-breaking demand because that record was already fully priced in. And the real shock was that supply grew even faster than anyone predicted. Think about oil. Imagine a headline that says demand for oil just hit an all-time high. Sounds bullish, right? But if traders had already priced in an even bigger number, that same headline can send prices falling within minutes. The world didn't actually change. Only the gap between belief and reality changed. And that gap is the only thing markets ever really trade. None of this is random noise. It's a system quietly grading surprise, not grading truth. And the traders who understand this aren't smarter because they predict the future. They're smarter because they stopped trying to. So here's the actual lesson. And it's probably not what you're expecting. It's not learn to predict the next data point. Nobody does that reliably. Not professionals, not algorithms, not anyone. And anyone selling you that kind of confidence is quietly selling you a lie. The real lesson is this. Markets don't move on what happened. They move on the gap between what happened and what everyone had already assumed would happen. Once that single idea clicks into place, it's not just one crash you suddenly understand. It's basically every confusing market reaction you've ever scrolled past and quietly shrugged at, wondering what you were missing. That's not some secret insider trading trick. That's simply how markets actually think. Quietly, constantly, one step ahead of the headlines. And now, so do you.